Hey guys, welcome to Plan Today, Own Tomorrow. My name is Gary Thurman, founder and CEO of Guardian Investment Advisors. Thank you so much for taking the time to listen to us on the radio or watch our show on Facebook or YouTube this morning. We appreciate all of you guys tuning in every week. And I tell you, it's always fun when our show plays over the weekends and we get the calls and the texts and the book requests. Means you guys are listening, and it means a tremendous amount to us. And today's show is going to be fun. So I got Tim McDermott in here with me, our lead advisor here in our Chattanooga, Tennessee office. And, you know, Tim, there's an old saying out there. There's an old saying when it comes to money. Go away in May, come back on Turkey Day. Yep. I mean, I remember your dad saying that years and years and years ago. So today I want to talk about, you know, the summer markets. I want to talk about the midterm election coming up. I want to talk about all the things that, you know, 2026 has for us in the market. And with you being the expert at this, I just thought this would be a good time as we're already in June. Can you believe it's already June, by the way?
It doesn't feel like it.
It's just happening crazy.
Already prepping for July 4th. My neighbor and I are going to do some big fireworks. It's going to be a good time.
It's going to be a big July 4th this year.
Summer of 2026 is here.
It's big. It's big. And we're starting to feel the heat from that as well. Just to throw it out there for all of you really, really quick, our Chattanooga office phone number is 423-710-9199. Up in Knoxville, go see Brogan. Our Knoxville number is 865-951-7526. As always, you can get a copy of my book, Plan Today, Own Tomorrow. There is a QR code at the bottom of your screen if you're watching us on YouTube or Facebook. But if you're listening to us on the radio, go to plantodayoffer.com. Plantodayoffer.com. We'll get you my book, Plan Today, Own Tomorrow, straight out to you in the mail. So, Tim, let's jump in. Every summer, it just feels like we got a lot of market volatility going on. I mean, it's been a trend for many, many years. And do you feel that that's just perception, or is there actually some history? Is there some meat on those bones that make people start worrying about the summer months and the volatility coming up?
No, there's certainly some evidence to prove that, right? We typically see some higher volatility in the summer months. It's why that phrase has been coined, go away in May, right? You typically see trading volume lessen. You end up seeing investors traveling a bit more.
Yeah.
You see the uncertainty from politics start to happen in election years, right? There's multiple reasons why these summer months become a little bit more volatile, but there's certainly a lot of evidence to kind of prove that and back that up.
And that's been going on for a long time.
Yeah, there's data on this seasonal kind of approach going all the way back to the 1950s that show you where a lot of that volatility comes from. And it's interesting, those charts show you a comparison of what a buy and hold looks like versus just the summer months versus just the kind of November through April months at the same time.
And I love when, you know, I see you and Bobby here in Chattanooga, Brogan up in Knoxville, and you pull up that chart and you show the people the historical data of the buy and hold strategy versus the seasonal, as you call it, strategy. It's crazy to me, the difference in the numbers. I mean, it's absolutely... It blows me away.
Yeah, and I'll take a step back here for a second real quick. As we kind of talk through this show, a lot of this is based on our seasonal strategy.
Yeah, let's talk about that for a few minutes.
So our seasonal strategy is interesting. It goes off of this old coin phrase of go away in May, come back again around Turkey Day. Essentially just saying, hey, these summer months are usually the most volatile. It's where we see a lot of these losses historically. And we want to be in during the strong period, which is that November through April time frame.
Right.
So a lot of what we're going to talk about is kind of based around this strategy in and of itself. That chart you're referring to has some pretty shocking evidence in there, and it shows even the early 2000s for the tech bubble and the 2008 crash that happened. Even 2022, when we saw that big drop happen, was early summer months, right? And so consistently over and over again, we see a lot of these large losses happen during those summer months.
And so we got the summer months coming up, and we're going to talk about midterm elections coming up soon, but we've got a lot of other craziness, if you will, going on in our world right now that could impact the markets, you know, along with the summer months. Don't you agree?
Yeah, absolutely. I think you're gonna see some ongoing volatility from what's going on overseas, and it's not just what we're involved with. There's still a lot going on internationally. There's a lot of international tension, and a lot of that's going to cause some volatility at the same time.
Absolutely.
So keeping a close eye on that.
It's going to be a stacking effect, if you will.
Yeah.
So here's a question, everybody out there, if you're listening to us today, we've got your attention on the summer volatility. Tim, should investors actually get nervous every single summer?
No. I wouldn't get nervous any summer, right? Have a plan that works for you. I know a little bit later on in our show, if you've heard us before, you've heard us talk about this bucket strategy.
Right, yeah.
There's a plan that goes into place for these things. But not every summer is volatile, right? We've seen years like 2013, even years like 2024, where the market just seems to skyrocket all year long. Yep. And so it's not there every single year. But I do see a lot of investors get nervous when we see years like that because they think, hey, there's got to be a pullback somewhere, and sometimes it never comes. In reality, the midterm election years are actually historically the ones that we say are the most volatile.
Right.
And so years like this year, I expect to see some volatility during that summer. But the third and fourth year of an election cycle are typically years where there's a strategy to this whole seasonal system that says don't sell out at all, stay invested all year long, and historically it works out pretty well for you.
So pretty much people could take advantage of the volatility.
Sure.
And come talk to you and Bobby here in Chattanooga, Brogan, and Knoxville, and really position their money to take advantage of the, let's call it a rebound, if you will.
Yeah.
If you look at historical numbers.
Sure.
What are some mistakes? I mean, I know there's got to be some mistakes people make when the markets get shaky like this, especially during the summer. What are some of the mistakes that you've seen in all the years you've been doing this that people actually make during these volatile times?
Yeah. This is an interesting strategy for me, right? Because a lot of folks look at it as market timing. It's not market timing, right? We're being proactive to what's happening in our markets versus reactive. You want to be cautious of reading these headlines and then saying, oh, I got to go sell out, right? A headline doesn't mean as much as it used to anymore.
No, it sure doesn't. Not in today's world. Yeah.
The news stations are out there to make money, and they make money by selling headlines, right?
Right.
So you want to be cautious with that. Don't panic. Don't make drastic moves. You should have a proactive plan in place, something that's there to deal with the volatility that you can handle, the risk tolerance that you can handle. The seasonal strategy gets mistaken that way sometimes, but it's proactive.
Sure.
It's not necessarily saying we're waiting for the crash to happen before we sell off. No. It will sell off during certain times regardless.
Yeah.
And that's the thing. You don't want to be reactive. If you're reactive, you have to be, or I guess if you're trying to time the market.
Oh, that's tough.
You have to be right twice.
Yeah.
You have to be right when you sell, and then you have to be right when you buy back in.
Right.
And that's really hard to do. Most traders cannot do this.
No.
And when I say most, I mean like 99%.
Yeah, most.
And so you want to be very cautious with that. It's not, there's going to be volatility. Know it's coming. It's good to know that it's coming and be prepared for it. There's no reason to be nervous about it. Right?
So you're pre-planning for these times.
That's exactly right.
So what's something you help clients with to stay calm during these volatile times, I should say?
Sure. With our seasonal strategy specifically, we're being proactive. And I think that makes people feel really good knowing that, hey, we're making these moves and avoiding this typical volatility that's out there. There's some stats that we use at the beginning of every year called the January barometer, right? And it says, hey, if the first 5 days are positive and then the whole month of January is positive, there's like an 84% correlation to the year as a whole being positive.
Okay.
And there's tons of data on this as well, right? If I can be right 84% of the time.
That's not bad.
It's pretty good.
That's not bad. So talking about that study, how did we look when we started up 2026 this year?
Sure. We had a shaky December this last year.
Sure did.
And what they call the Santa Claus rally was actually negative this last year, which doesn't lead very well into the January months
Right.
and leaves a little uncertainty that's there.
Right.
But the first 5 days and the January barometer were actually positive this year. So it did bode well for what's looking forward to.
Yeah.
To
I
this
think
year.
the whole concept of this is if you've got money in the market, you got to have a plan. You got to pre-plan for things like this. That's why it's so important for folks to sit down with you, sit down with Bobby, sit down with Brogan. Don't get worried. Don't get emotional during these times because you've put a plan together for them. Is that correct? I mean, that's the key here, having a plan.
Yeah, absolutely, and matching the risk tolerance appropriately is what truly matters to any investor, because it's when the market's good, everybody's making money. It feels
Everybody's
good.
happy.
Everybody's happy. So when the market starts going sideways or down is when you start to see that kind of panic or that concern happen, and being able to go back to your client and say that's why we put this together the way that we did. It's why this money's protected. It's why this money has the growth set up.
Right.
That's the reassurance that most folks need.
I love it. If you're listening to us today, I would invite you to give us a call, 423-710-9199. Set a time to come in, have a complimentary review with Tim and Bobby in Chattanooga. You can also call Brogan up in our Knoxville office, 865-951-7526. And as always on our show, we give you my book absolutely free. All you have to do is go to plantodayoffer.com, plantodayoffer.com. When we come back, midterm elections are coming up here really, really soon, and that's going to be our focus on our next segment. You don't want to miss that, especially if you're someone out there that has money in the market. Stay tuned. We'll be right back.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Gary Thurman with Guardian Investment Advisors. If you've amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. All of our advisors are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call now for your own complimentary portfolio review and tax analysis. Welcome back to Plan the Day on Tomorrow. My name is Gary Thurman, founder and CEO of Guardian Investment Advisors. Having a great show today. We just spent our first segment with Tim McDermott talking about, the summer months and how they tend to be volatile. And historical numbers just show us the facts of how summer months are usually more volatile than other months throughout the year. Not every summer. And that's why we think having a plan together is essential for this. Now, you may be asking yourself, wow, do we actually have too much risk in the market? I got a quiz that I'm going to offer you guys to go take. It takes about 3 minutes to take this quiz. It's GIARiskquiz.com. GIARiskquiz.com. Tim, I'm going to throw a slide up here on our screen for our folks watching on YouTube and Facebook. And this slide really talks about the 6 biggest risks in your retirement. And the very first one we see up there is market risk, which is what we're talking about today. Because there does come a time in your life, there is a time in your life, let me go back, when you're younger, that being in the market, having a tremendous amount of risk, and that's where you need to be.
Sure. Because
you need to maximize your growth. We do feel here at Guardian, once you get a little bit older, then you have to adjust some of that market risk that you have. And that just falls in line to what I want to talk about now. Midterm election years. Again, we're looking at historical numbers. They usually be, they're pretty volatile.
Sure.
But there's also some rebounding effects to that. So let's just jump in. What makes a midterm election year different than any other year?
Yeah, well, we're going into elections, right? That always causes some uncertainty, politically, emotionally, markets-wise. Across the board, there's some uncertainty there. Mm-hmm. Here's the big shocker, right? The markets don't care who's in office.
True.
They just
want to know.
They just want to know.
Yeah.
That's exactly right. And that's the big key factor there. They don't know the summer leading up to those midterm elections, and uncertainty is what causes volatility in our markets. So here's a cool little political stat, right? Right now we have the Republican trio. We have Congress and the presidency that's there, the House and the Senate. So statistically speaking, either the House, the Senate, or both will flip this election period, right? And that creates some uncertainty for some people. They don't know what's going to happen. They don't know what kind of policy changes are going to come into place. The markets get a little shaky in that because people get nervous about what's going on.
Yeah, sure.
But once the election happens, things typically go upwards.
They do.
And here's the amazing thing. Volatility this summer, right? That's what we're expecting. I think we've beat that horse enough.
Yeah, we have. We've talked about that. Yeah.
But the fourth quarter of this year and the first 2 quarters of next year historically are the best period in the market over any 4-year election cycle.
Wow.
So volatility followed by potential growth.
Yeah. So you're saying that the midterm, again, summer months, we've talked about that being volatile. Then we're going to go right into the midterm election months. I mean, you talked about it a little bit, but is there more facts about what actually happens during midterm? I mean, it's just basically comes down to the unknown. I mean, am I correct on that?
Yeah.
The market wants to know who's going to be in office.
Yeah, no, that's exactly right. And that's what causes a lot of the uncertainty. We're also in, and if you think about this from a bigger picture view, we're in the second year of the presidential election cycle, right? So the first year, new president takes office. They want to make a lot of changes. They've got this big plan that's supposed to boost the economy, that's supposed to do this. Year 2 comes around, right? And what usually happens?
A lot of flipping.
Yeah. Because whatever politician goes into office usually makes these big promises, these big plans, these big goals, and they don't always work out exactly the way that everybody hopes they would, right? And so then people say, okay, well, that didn't work out the way it was supposed to, and the market starts to pull back, right? So you have a little bit of that combined with the uncertainty of political powers in place, and that's causes a lot of this shakiness, a lot of this volatility.
Yeah, and I love the fact that you use historical numbers. I mean, we always say, everything repeats itself. That's not necessarily true all the time.
No, but history does repeat itself over and over and over again.
And when you can show people those stats and those facts, that's pretty cool. So summer months are volatile. Midterm election, going to be volatile. But is that the time for everybody to get out altogether, to sell?
So not necessarily, right?
Okay.
I think this depends on your time of life. You mentioned earlier, if you're younger, this volatility actually can work in your favor.
That's right.
Yeah. If you're young and you're adding to that 401k, you're buying on the way down with this market because you're consistently adding to it. That actually works out in your favor because you're buying in lower parts, and when it comes back up, it works for you. The opposite is true when you're retired and you're drawing from those accounts.
Yeah, big time.
If you're pulling from those accounts while it's coming down, you've got a double negative there, and that can really hurt the portfolio, which is why the plan is so important, and you need to have it in place before things like this happen.
Absolutely, that's where that plan comes together. Tim, we've had clients come in. You've told me about some conversations. So has Bobby. So has Brogan up in Knoxville about people who try to time the market. It's almost impossible to do. But, I mean, there's people that try to do it all the time, but what happens to most of those people when they try to time the market?
Yeah, you end up dragging behind market returns that are there. And I think the goal there is typically to say, hey, I want to get rid of some of these losses and increase the gains, right? But you end up seeing what happens is these losses come and you sell, you miss the rebound, so you miss the return, but you took the loss,
right?
And then you don't know when to get back in, right? And that's a tough thing to recover from.
Absolutely.
Right? You either need to be proactive about it, or you've got to just get rid of this timing thing.
That reminds me, I talked to a lady just yesterday morning down in Baton Rouge, Louisiana, and she had talked about years ago. She put $25,000 into this account.
Sure.
And at the time, she did not want to take a lot of risk with it because that was a lot of money to her back then. But she said, I've been in this thing 40 years now, and it's done nothing. And she goes, I'm beat myself up because I just didn't pay attention. And I think we might see a lot of that. A lot of people just, I'm in a plan. This is what my current advisor told me to be in. I'm just going to stick it out.
Sure.
That sometimes can be a good thing, but that really neglects the planning side of it. There was no planning involved. You're just setting an account and hoping it does well.
Yeah.
Hope is not great.
Well, it sounds like she made an initial move, right?
She made an initial move, but she didn't make any changes.
Which is somewhat of a plan.
Yeah.
It's part of the plan. It's the
Yeah.
start of the plan. Unfortunately, the planning process in today's world is never stagnant, right?
Yeah.
You can't just sit there and let it go forever. And it needs to be adjusted. It needs to accommodate for policy changes and tax changes and market changes, economic